You can follow all the traditional financial advice, saving diligently, investing early, and grinding away at your job, and still feel like you're never getting ahead. If you look at the Forbes 400 list, you'll notice a glaring detail. Out of the wealthiest individuals on the planet, exactly 0 of them made the list through a salary or earned income alone. The gap between high earners and the ultra-wealthy exists because standard financial rules are designed for laborers. Capital, on the other hand, operates on a completely different set of mechanical laws. Crossing that wealth gap requires engineering a system built on 3 specific pillars: momentum to compound the money, structure to control the outcomes, and asymmetry to maximize the upside while capping the downside. Transitioning to this 3-part system provides the mechanics necessary to move beyond trading labor for cash and start engineering exponential compounding. We often confuse fast action with fast results. When dealing with real estate, speed looks like buying a single-family property, fixing it up, and flipping it quickly for a cash payout. Over that same 5-year period, a different strategy utilizes time. An investor buys a single-family home, holds it, extracts the equity to buy a 4-plex, and eventually upgrades to a 20-unit complex. The flipper generates immediate cash, but the hold and upgrade strategy generates a net worth 5 times higher. Warren Buffett proved that identifying high-quality assets and holding them indefinitely is the true engine of momentum. This chart tracks Berkshire Hathaway's returns. From 1965 to 2024, they compounded at roughly 20% annually. By simply allowing time to do the work, their total historical return hit 5 million%. While acting quickly is great for seizing an immediate opportunity, holding on to a good decision and letting the math multiply is how actual wealth is built. Once you understand how money compounds, you have to look at who actually benefits from that growth. In any financial transaction, the person who provides the capital controls the terms and dictates the outcome. This is why the vast majority of the wealthiest people on Earth are buyers and builders. They systematically acquire businesses and assets, locking in structural control over the equity. Investors scale these acquisitions by utilizing the most powerful tool in finance: leverage. Buy $1 million property in cash and its value increases 10%, your return is 10%. Put down $200,000 and borrow $800,000. That exact same growth yields a 50% return on your investment. The ultra-wealthy apply this exact logic to the stock market. When Elon Musk acquired Twitter, he used his Tesla stock as collateral to borrow the capital needed for the purchase. Because borrowed money is legally classified as debt rather than income, it doesn't trigger a taxable event. They acquire massive new assets without paying a cent of income tax on the capital they used to buy them. Cash flow pays for your house, funds your car, and your daily life. But acquiring and controlling heavily leveraged equity is what actually buys your freedom. Most of us are taught that financial risk and reward exist on a simple linear scale. You risk $100 to make $100. Venture capital firms operate differently. By investing $100,000 into 5 separate companies, maximum potential loss is exactly $500,000. While several investments may drop to 0, a single 100-fold return instantly recaptures all losses and generates massive profit. Investor Ray Dalio takes this further by optimizing for the downside. Instead of seeking higher returns and accepting more danger, the goal is to keep the target return exactly the same while actively reducing the amount of risk taken. While Wall Street preaches wide diversification, elite operators prefer to concentrate their investments into a single business. Because they possess insider information and direct control over the company's decisions, their actual risk is significantly lower than a retail investor buying blindly. Generating substantial wealth requires sizing your bets correctly. You ensure your financial survival by limiting your downside and structure the math so the potential upside is virtually limitless. Applying these laws provides a practical filter for every financial decision moving forward. Ignoring them is how people get wiped out. Consider an investor who poured his entire life savings, $700,000 built up over 15 years, into a single highly commoded offshore oil and gas deal. When the investment collapsed, his entire empire vanished in an instant because he failed to cap his downside. Before allocating capital, Ask yourself 5 specific questions. Can this investment compound over time? Who controls the outcome? What happens to my money if it fails? Is the upside mathematically meaningful? And finally, do I clearly understand the risks? Breaking through your financial ceiling means walking away from the traditional rules of manual labor and adopting the rigid laws of capital architecture. The path to true wealth involves owning the machinery and letting the fundamental laws of leverage and time do the heavy lifting for you.